Welcome to Spring into ETF Investing. On today's special episode, our panel of guest speakers will be discussing fixed income ETFs and tax.
This is ETF Market Insights, and I'm Erin Allen, VP of Online Distribution with BMO ETFs. Welcome to the channel. For those who are new to our channel, our goal is to provide timely market-related insights and ETF-focused education to Canadian do-it-yourself investors, with the goal to become your trusted partner in investing. We want to bring you access to the same level of high-quality resources that advisors and institutions receive in our industry. Before we begin, a quick reminder that today we are not providing you investment advice or recommendations. Our channel is all about providing education around investing and around ETFs. And now I'm going to turn over my hosting duties to Cornell Schreiber. Cornell is the host of the Build Wealth Canada podcast and is well known for becoming one of Canada's youngest retirees at the age of 32. He runs a top personal finance and investing podcast created specifically for Canadians. We're excited to have him host today's session. Cornell, over to you.
Welcome to ETF Market Insights. I'm Cornell Schreiber from the Build Wealth Canada podcast. Joining me in this discussion is John Waters, Vice President, Director of Tax Consulting Services at BMO Private Wealth. John is a seasoned tax specialist, leading high-level planning discussions, presenting tax seminars, and writing on emerging developments in his field. We also have Matthew Montemuro with us from BMO ETFs. Matt is the head of fixed income and equity index ETFs at BMO Global Asset Management. He is a CFA charter holder with over a decade of investment experience. Matt, before we get into the topic today, can you give us a bit of an update on how things are with the current interest rate environment as well as the fixed income market?
Yeah, absolutely. So 2024 has had quite the start. Let's rewind to the end of 2023. There was optimism in the market. Both in Canada and the US, expectations were that we were going to get rate cuts. They were going to be early, and we were going to get them often. Well, it quickly 2024 turned, and those expectations started to get dismissed, and they really started to get pushed out later and later into the year. So here we sit. The Bank of Canada is now poised to likely be the first to cut. So we're expecting the first cut in Canada to be in June or July, with the market expecting about 2 or 3 cuts for the year. But this is where the expectations start to diverge. We're starting to see Canadian and US policy kind of diverge right here, where the Fed now is pushing rate cuts later, really starting to sit on that higher for longer narrative as inflation has continued to be stickier in the US than we've seen in Canada. So right now, if you're looking right now, the expectations of rate cuts in the US, it's only 1 cut for the year, and it's going to be November or December. So the big question on a lot of people's minds is, with the election coming up, how will that affect Fed policy decision making, and will they be forced to wait until after the election to start cutting? And that's what we're all keeping an eye on right now.
John, we've had a lot of fixed income inflows, a lot of it due to the high interest rates that we've been seeing. Now, what I really wanted to talk to you about, though, is how fixed income is taxed. Obviously, there's different ways that it can be taxed. Can you speak to some of those different methods? What kind of taxation can fixed income investors expect?
Yeah, so typically it would be primarily interest income. So I think of a GIC or a government or corporate bond with a stated coupon rate. When you receive that interest, of course, it's fully taxable, included in as regular income on your tax return. But you also might see a capital gain or loss. And sort of coming back to the corporate government bond scenario, stated coupon rate, it would be trading at either a premium or a discount, depending on what the coupon rate is relative to the market rate of interest. And if you hold that to maturity, you would have a capital gain or loss, depending if it was sold at a premium or discount, or if you sold it before maturity, in addition to the interest income that you're picking up, you'd also have a capital gain or loss. So those are sort of the 2 main components that you would see from a tax perspective.
Can you speak to the tax treatment differences between a traditional bond versus a bond ETF?
Very similar from the big picture perspective. To break that down a little bit more, if, say, the prevailing market interest rate right now is 6% and your bond has a coupon rate of 5%, it's going to be trading at a discount because you could get more out in the market. So when that you hold that over the term to maturity, and you'll receive the interest on a regular basis, of course, picking that up fully as interest income, and you hold to maturity. In that scenario, you're going to have a capital gain. So the difference between what you paid at the discount to what it matures at the face value, the par value, is a capital gain. Converse, flip that around. If the bond that you're purchasing, again, has that 5% stated coupon rate and the prevailing interest rate is only 4%, you're buying that at a premium because it's paying more than what you get in the market right now. Hold that to maturity, you'll continue to receive your interest payments. And at maturity, you would actually get a capital loss because you've paid more. You've paid a premium more than the par value. So that difference is a capital loss at maturity. Putting that into more of a macro perspective, when we're thinking about a mutual fund or an ETF, basically it's pooling all these individual investors into the same fund and purchasing an entire, like a huge bond portfolio. So you're gonna have a bunch of these different types of bonds and interest-bearing investments. And at the end of the day, that trust, that mutual fund, that ETF is just a conduit. So any of that income that it's earning is flowed out to the individual investors receiving their proportionate share. So generally that's going to be the interest, the capital gains, and in some situations, maybe a return of your own capital that you've invested.
John, I hear that fixed income can actually be tax efficient at times as well. Can you explain why that is? And for those investors that are fixed income investors that are looking to take advantage of this tax efficiency, how can they go about doing that? What should they be looking for?
Yeah, so right now that opportunity exists with discount bonds because of the way that they are taxed in the different components. So again, coming back to a scenario where you've got two different choices, two different bonds with the same yield to maturity. One is trading at a discount because the interest rate, the coupon rate is low compared to the prevailing market interest rates. So you would buy that and pay less than the par value, receive those lower amount of interest payments at each coupon payment. And then the difference, as I mentioned, when you, at maturity, that difference is a capital gain. Contrast that to another type of bond that is trading at a premium because the coupon interest rate is higher than the prevailing market interest rate. So you continue to hold that, receive those higher amounts of interest income, and then at maturity, you actually have a capital loss because you've paid more than the par value. So that difference, capital loss, could be offset against capital gains that you might have in other securities. So in that scenario, it's actually more tax inefficient because you're receiving a significant a higher amount of interest income and then the capital loss. Whereas in the discount bond scenario, you're receiving lower amounts of interest and a capital gain. And recall that capital gains under the current tax legislation are only included at 50% as opposed to 100% on interest income. So even though you might be receiving the same amount of income in both scenarios, the discount bond is going to be more tax efficient because of that capital gains component and the lower interest component. So the net after-tax amount in your pocket is going to be more. And for a taxable investor, someone investing in a non-registered account, that's what's critical.
Matt, with rates expected to come down, what will this mean for the fixed income market in general, as well as the tax efficiency of discount bonds?
Generally, in an environment where rates are coming down, it is a positive for fixed income. So longer duration, longer term bonds tend to outperform because they have a higher degree of sensitivity to interest rate changes. So, yields come down, prices go up. So you tend to see outperformance of fixed income in periods where rates are coming down. In a vacuum, if rates are coming down, that means yields are coming down. And if coupons are relatively stable, that will make the overall fixed income universe less tax efficient. Because like John said, that differential between coupon and yield to maturity, that's really where that capital gains portion is that makes the fixed income environment more tax efficient currently. So yes, in a vacuum, you are going to have fewer discount bonds available because prices are going to go up and there's going to be bond prices that go above par. But that also, I think as investors, we have to remember in 2020 and 2021, we saw record issuance at record low interest rates. So there's still going to be options for bonds that were issued 5, 7, 10 years ago for us to pick and choose, bonds that have coupons between generally 1% and 3% that would still exhibit characteristics in that same tax efficiency. So overall, from a universe perspective, yes, the overall fixed income universe will be less tax efficient as a whole, but there still will be opportunities for investors to pick and choose between very specific discount bonds and still take advantage of the tax efficiency inherent in the fixed income market.
Matt, let's talk portfolio construction strategy for a minute. Since the rates are on pause, would it be better to go for shorter duration when it comes to our fixed income, or should we be considering going for longer duration?
Yeah, so I think the trend we've seen in the last 18 months has been everybody sitting on the sidelines, staying in cash, money market, really optimizing, taking advantage of that inverted yield curve, getting paid 5% to basically wait out the volatility in the market. But as we look forward, we do expect rate cuts to come. So right now in Canada, we're seeing June or July as the first cut, and we do expect to see kind of 2 to 3 cuts for the remainder of 2024. So, on the one hand, I do see investors, at an absolute level, you're still going to be getting a yield of 475, 450, 425. And if you look historically, that's still quite attractive. So I think we're still going to see investors sit on the sidelines, take advantage of that short end, those higher yields. But I do think for investors who are looking longer term, who are looking at returns over the next year, now would be the time to start considering adding duration to your portfolio. Duration, again, when yields come down, bond prices go up, and that's when duration is your friend. That's what's going to give you some upside in the fixed income portfolio. So I wouldn't recommend investors necessarily going all in on the long end, going to buy, the 2053 bonds in the market. What I would say is looking at a more aggregate solutions like ZAG, our BMO Aggregate Bond Fund, or ZDB, our BMO Discount Bond Fund. That provides you with full term exposure. So short all the way to the long. You're getting a duration of about 7 years. So you're going to have some of that upside in terms of when rates come down, you're going to have that sensitivity to interest rates. But if we see cuts slower than the market expects, you're going to have that exposure on the short end that's going to provide you that downside protection. So that's where I would say investors should start to consider adding duration to portfolios, but I would do it in a more aggregate manner in ZAG or ZDB rather than going necessarily all in on the long end.
And Matt, we've seen a lot of inflows into the high interest savings accounts ETFs, also known as HISA ETFs. It seems that a lot of GIC investors, they like having that security for their cash. And that seems to be very appealing for them. What kind of solutions does BMO offer when it comes to this area?
Yeah, BMO, we have a very comprehensive suite of cash alternative products. So, both whether it's Canadian dollars or US, we have products that offer across the spectrum of risk and yield. So on the lowest risk side, we have something called ZMMK, which is our money market ETF. That provides investors with the most security, but also provides them with an yield enhancement relative to a HISA if you're looking at kind of an apples to apples comparison. So for investors who don't want to take any risk on that cash allocation, but still want a yield enhancement, ZMMK would be an excellent solution for them. For investors who are willing to take a little bit more credit risk, but want to maximize the yield out of that cash component while they can, because, if everyone's saying rates are coming down, they may want to maximize that yield right now while they can. So something like ZST, our BMO Ultra Short-Term Bond Fund, it invests in high quality corporate bonds that are 0 to 1 year to maturity, and we hold those bonds kind of from 1 year all the way to maturity. That would provide you with a little bit more credit risk because you are investing in corporate bonds, but you're also getting a yield enhancement relative to both money market and HISA. And as we've talked about that tax efficiency, because we're investing in, again, corporate bonds here, ZST will have a significant after-tax advantage for those taxable investors who want to maximize their yield.
From a tax perspective, what are the key differences between something like a high interest savings account, ETF or GIC versus ZST, for example, from BMO?
Yeah, so from a HISA or a GIC or a money market fund, that's going to be anything you earn, that top level yield that you see, let's call it 5% today, that's going to be 100% interest income. So when you look at your returns for a taxable investor, your expectation should be that is going to be taxed as income. For ZST, you're seeing a little bit of a difference in characteristics here. You're getting a coupon of about 2.75 and a yield of about 5.5. So 50% of that return will be income and 50% of that return will be capital gains. So when you're looking at comparing them for a taxable investor, there's significant after-tax benefits of owning the bonds in ZST versus the alternatives like a GIC or a HISA.
John, can you speak to the increase in the capital gains inclusion rate that we saw after the federal budget? Does that change your analysis and your recommendations at all?
No. So there were some proposals in the recent federal budget about a month ago to increase the capital gains inclusion rate from 1/2 to 2/3 after June 24th. So does change the number slightly because, of course, we're talking about the difference between taxation of interest income at 100% and capital gains today at 50% and potentially at 2/3 in about a month's time. So, however, the capital gains, of course, even at a 66% inclusion rate, will be better off than interest, which is obviously fully includable in income. So, slight loss of tax efficiency there. But I would point out that that these are only proposals and that there is the first $250,000 for an individual investor is proposed to remain at the 50% inclusion rate and not go up. So even if it is at 2/3, it still makes sense because of the capital gains is still taxed less than interest. But for most investors below that $250,000 threshold for individuals, they're probably not going to be affected by these changes.
Matt, as we are in a US election year, are you seeing any sort of trends when it comes to investing, particularly on the fixed income side of things?
Yeah, so I think that's the top of mind for every fixed income investor right now. When we're looking at trying to predict what the Fed is going to do, the big question is, if the Fed doesn't come this summer, and right now it's not expected to, will they be willing and able to cut rates prior to the election? There is historically, the Fed has tried to sit out, election periods. They don't want to add fuel to either candidate, add any sort of policy. They don't want to be part of the conversation on the run up to the election. So a lot of market participants think if they don't come this summer, that they'll wait until after the election to start to cut rates. So now we're already looking at November or December for the first rate cut in the US. So that's something that a lot of investors are pondering with. Will they be willing to come in the fall if they think that's the right time, or will they just wait it out until the election comes? If you look historically at what happens in markets during election years, volatility increases, which makes sense. If you have uncertainty on policy, if you have uncertainty what candidate's going to come into play in the political system, that just brings uncertainty and volatility to markets. So traditionally, what investors have done is they've taken their money out of the equity markets, they've out of the bond market and moved it into money markets. So, basically risk off trade, moving on the sidelines and allowing that volatility and outcomes to kind of come to fruition. So we expect that trend to continue. We've seen 2 years of flows of short-term rates and into the short term. And if the Fed's not going to come and cut rates and we're going to have increased volatility in equity markets because of the election, it makes a lot of sense for investors to either stay or continue to migrate into the short end. So we do expect short-term fixed income to see increased flows throughout the second half of 2024.
Great. Well, gentlemen, thank you so much for coming and for sharing your insights with us. It's clear that navigating the fixed income market can present its own challenges and opportunities. So thank you for sharing some of your thoughts around how investors can consider the taxation of fixed income ETFs and how there may be some attractive opportunities on the horizon for investors. Thank you so much to ETF Market Insights for hosting this great discussion. It's been a pleasure to be here today.